Joining us today to navigate this collision of energy shocks along with regulatory lockdowns, which we'll get into all of that, is one of the most sought after minds in global macro strategy, a top 100 financial advisor, tax attorney, and author of Wealth Unbroken. She specializes identifying the hidden tax within the Fed's narrative. That, of course, is going to be Rebecca Walser joining me today. And we're going to dive into how the Fed is going to navigate what's going on in the Middle East. What does that mean for markets right now? Because we're seeing somewhat of a meltdown, almost 10% in the last 2 weeks off the S&P. Today's episode is going to be a banger. Stick around.
I want to take a minute, guys, and just invite you to join the Barron Market Edge private member group. You guys can do that by just clicking the link down in our description. This is your insider's edge to the AI and crypto money revolution, which is what we really focus on here on PBN. This is additional research that I do along with our team. We have a pretty significant team on our research around not only what guides our episodes, but a lot of that research gets built into more content that I drop here on the Barron Market Edge. We do market trends and sentiment analysis, which can be anything from tokens to all sorts of strategies. This, of course, will also guide you over to our Telegram group, and we give this as elite community access. You get bonus content over there, including tax guides, as well as different kinds of asset guides out there that we drop all the time. This is your 10-year vision in action. All you have to do, of course, is just hit that little subscribe button or join the community and get in on it. It's absolutely free. It doesn't cost you a thing, so check it out.
All right, so Rebecca, welcome into the show. How are you?
I'm great, Paul. Thanks for having me. And just ignore if my nose is running a little bit, just adjusting to this winter, spring weather. Can't
I feel
adjust.
for you. I had it last week and it literally stuck around for a week for me.
Okay.
But mine are because I have, younger kids and they love to bring stuff home from places,
Totally
which
get
is
it.
the best. Hey, I've got to share the S&P 500 real quick. I just want to kind of framing the market for everybody that's watching and what we're looking at right now. So the S&P off almost 7K, which was back here at the end of January.
Mm.
Here we are now, middle of March, into March coming in, and we have dripped all the way down. If you look at the low point right there, we were at 6,400, but right now today, waffling around 65 to 66. You look at this right here, and I know you're a wealth manager at Walser. Let me bring up your website for everybody in case you haven't visited her website. Walser Wealth Management does a great job, but you get a chance to see how a lot of wealthy individuals, family offices, etc., are trying to navigate what is happening in the Middle East, and then also at the same time, what is happening with the Fed. All right, so let's start with the Fed first. You saw the statement from Chair Powell last week, another pause, and now even influenced a little bit that there could be a potential rate hike. So, first of all, when you heard that, what did you think?
Well, I thought the tone of Powell was not necessarily what he said, but how he kept mentioning tariffs over and over and over.
Yeah.
And his tonality seemed very challenging to Trump. And also letting Trump know, I thought it was a direct shot across the bow. Hey, I'm going to stay as long as the Department of Justice is investigating the
Yeah.
boondoggle of billions that has been spent on the renovations of the Federal Reserve building. And also letting Trump know that he hasn't decided what will happen after that inquiry finishes. And then is interested in potentially leaving or not leaving. He hasn't made that decision. So I think that the shot across the bow is I could potentially be a thorn in your side for a lot longer.
Yeah.
And I am not a fan, and I'm irritated. That's what I really the undertones of the message that I heard from him. As far as what he actually said, nothing too revelational, because again, this is his second to last meeting as the chair.
Yeah.
He has one more before May. Basically, there was almost a 0% probability of any kind of cut. And of course, that backdrop was inflationary because we saw ECB, BOE, we saw
Right.
other central banks actually talking about hikes and the tone shifting from cuts to hikes. And really, if you start to look at the weakness in payroll, 5 out of the last 10 payrolls have been negative. So what you're looking at is payroll weakness, and you're looking at payroll weakness in the face of inflation with the oil, and I call this an global oil crisis at this point, because we don't know when it's going to get resolved, and if, of course, we don't get a resolution quickly, then you're looking at really payroll weakness into an inflationary environment, which is
Yeah.
really beginning stages of stagflation.
So we've talked about labor, you and I, before. Jobs are coming in softer. Now we have the issue of inflation potentially looming. However, at the same time, you have something happening in the oil market that I think is interesting. Let me bring up the West Texas crude chart real quick,
Hmm.
just so people can kind of see this. This is very intriguing to me. So you've got, if you come off of the high there, which was in 2022, back in June, we were around 115 a barrel. Okay. Of course, it's been on a downward spike since then. We had that bottom at around $55 a barrel. Can you imagine that? $55 a barrel. It was great, great gas prices.
That's them losing money, by the way, Paul. That they're
Yeah, they're not
losing
making
money.
money there.
Yeah, they're
Exactly. Yeah,
losing
it's
money at that
75, I
level.
think, is a sweet spot, right?
Exactly. It's like
Yeah.
break even ish. Yeah.
Yeah. So you're in that range. You start this spike, and I'm on the monthly right here.
Hmm.
And then here we are right now around 80. And if you go to the daily, you're going to see we're right at about 86, 89 to where we are right now. So you have this happening, but at the same time, you have December futures on oil coming in at $75. So you look at this, and then I was looking at a dashboard that I thought was interesting. If I can pull it up, this was a dashboard that was a. Have you ever heard of a structural resilience simulator?
I don't believe so.
Okay, so what they do is they look at the market and they compare the amount of imports that are being impacted on GDP. And then they calculate this of how many weeks that we're into the potential of the disruption,
Mhm.
and then the market expectations along with the SPR, the Strategic Petroleum Reserve buffer, and the current spot price under demand destruction should be somewhere around $169 a barrel. So that's where we should be if SPR wasn't in there and some other manipulation that seems to be happening. And then you have the futures market coming in at $75 in December.
Yeah,
So explain to me this. Doesn't the Fed have access to all this information?
absolutely.
So if they're looking at it and say, well, wait a minute, somebody's or keeping this price moderated, do they know something around where, this is going to end? And if we're back at $75 a barrel in December on these futures prices, I mean, essentially it's like nothing happened in the market. So why wouldn't the Fed be looking at that and say, okay, we don't think inflation is an issue. We just have to worry about jobs. And the only way to do that is cut rates.
Is to be accommodative.
Yeah.
Yeah, I mean, the only thing that makes any kind of logical sense is one of two things. Either they have some kind of inside information from the right groups that let them know that this conflict is going to have an end date. Hell or high water, it will end and
Yeah.
things will get somewhat back to normalcy. I can't imagine that that could have any impact. It can't just be an industry head saying it. It can't be an executive saying it. It has to be somebody that has, knowledge of what the plans are inside the Trump administration. Because
Yeah.
obviously, if they decide, oh, we're going to walk away and leave things as that, we feel like they can dress this up and say we achieved this, and we're done, and we don't want to send the world into an energy crisis. So there's that. The only thing I can think is there's some kind of inside information stating that we will pull back. We will not allow a global energy crisis. However, Paul, I want to balance that with saying that just the Qatar energy damage to their main
20%.
plant, which it provides 17% of the world's LNG, liquefied
Yeah.
natural gas. That has been damaged to the point that Qatar Energy has said it's going to take 3 to 5 years to repair. So, we also obviously saw Trump open up potential sales from Russia to outside, groups that were previously sanctioned because of the economic sanctions that we know were put in place from the Ukraine invasion in March of 2022. So,
Mhm.
all I can say is when I look at the Fed Watch tool to see inflation projections of what the Fed's going to do, we're looking at zero cuts all the way into, and I have to go to July of 27 before I get any kind of probability less than 50% that we're either at the same level or higher. So whatever information is being priced into the oil futures for December futures contracts, that information is not equally getting disseminated to the
Yeah.
FOMC, rate watch tool, because that tool is very clearly stating that we actually have a probability now, small, but we have some probability of rate hikes, and we don't get any probability of less or greater than 50% of being off of our current level until July of next year. So there's disinformation or miscommunication between these sectors, between what the actual interest rate probabilities are versus what the oil futures are. So something is letting oil futures know that they do not expect this conflict to, one, either be
Yes.
sustained, or two, even the impacts that we've already seen. Like, for example, you saw the administration telegraph, we won't bomb any more of we are going to take out the Iranian power, because that's what Trump had said. When once Iran, and that we believe that missile and the long range, that the world saying, wow, they have the ability to strike a target way farther than we previously thought. I know you and I talked, you think maybe, we don't know if it was definitely
Could have
Iran
been a
or
false
not.
flag. We don't know.
It could have been a
Yeah.
false flag, but the fact is that, this is a conflict that, based on what has happened, could easily get escalated. Trump used the escalation language, which I believe is his art of the deal kind of
Yeah.
mentality.
Yeah.
That's his mentality of, I'm going to go in really hard, like I'm going to say 100% tariff, so that when we back down to 30 or 20 or 15, people will think,
Yeah.
well,
It
that's
looks like a
reasonable.
deal.
Well, yeah, it's a deal. It's a deal. It's like a discount off of something that wasn't really real in the first place. So all I can say is that, even though he's saying we won't bomb the Iranian power plants, which would take out the power structure of the entire country, which again, the strait needs to get reopened, Paul. And the only thing I can think is, with the military operation and 3 units being deployed over
Yeah.
there to get the strait reopened, having some kind of a consortium of other countries that will flotilla going through the strait, that has to get reopened. And if they have a plan for that happening fast, that's the only reason I can think that the oil futures would be where they are for December.
Okay. All right. So something's not jiving here yet, or somebody knows something. If you just look at those December futures, you look at the Bitcoin chart. Let me show you this, because this is a very intriguing period of time. Let's go to Bitcoin.
Mhm.
Iranian war starts on February 28th. Okay. And since that, Bitcoin up 7.7%, trading today at 70,900. All right. If you compare that, we'll go back down here to the S&P, and kind of in that same zone, we'll go into December or February 20. Here's, where is that? Right there. 26, 7, 8, right there. So trading off of, not off the top, but off of about 6,800. So it was probably, if you went to the bottom on that, if you go into that February 28th range, where are we? There we go. So right here, because you kind of have to go there.
Mhm.
All right. So down to the bottom, almost 6%. So are we seeing flight right now out of securities into assets like Bitcoin? Because gold is also down as well. Is it Bitcoin that is winning this, or is this just a temporary movement of capital trying to figure out what? Or was it a flight of capital out of Iran, Dubai, all those areas that were concerned about what was happening, and Bitcoin was just the easiest way? What are your thoughts?
Yeah, it's really interesting. I think Bitcoin is both winning and losing at the same time. Obviously, we had a routing of Bitcoin the last 6 months. It's been, really felt like it was almost insurmountable. And then we did get back up at the beginning of the year. You look back at January and you're looking at the 95, 100,000 range, and then dropping back down. So
Yeah.
I feel like, on the metal side, to really clarify what I believe is happening with metals, I think it's a tripart pressure on metals. The first being, the central banks are looking to liquidate, because we're looking at energy crisis. And so you've
Yeah.
got a lot of countries around the world where central banks are like, oh my gosh, this is going to cost us more. We've got energy problems. We are going to have to liquidate some capital. And obviously, central banks have been one of the largest investors in precious metals in the last 3 years. And that's really because Basel III and all of the things, really currency transition, moving from the West to the East, the BRICS bloc, all of these things have absolutely made central banks be massive buyers of precious metals. In the middle of an oil crisis, they have been huge sellers of metals. And I think they're raising liquidity and they're getting
Yeah.
capital and they want to prepare themselves for dealing with a potential energy crisis. So that's the first thing. The second thing that you have a really strong dollar. And that makes a lot of sense because we have a trifurcation, if you will, which we've not really seen before, Paul, at least not to this extent, of energy price in Asia versus Europe versus the US. So
Exactly.
obviously, with WTI and us being energy independent since Trump's first term, we have the lowest price for basically oil, Brent,
Yeah.
or crude, even though we're landlocked with Texas, there's transportation costs are higher. We are still the cheapest. Now, if you look at Europe, they're in now the middle of an energy crisis. They had problems, obviously, not being able to buy all of their supplies that they had previously from Russia, and then LNG's restrictions and all of those things with the Russian sanctions. That was already a problem. They decommissioned a lot of their nuclear power plants because they don't believe in them. They're not green, whatever. And so they don't have that. So they have to be buying and they have to be a buyer of someone else's stuff. So their energy crisis, they're in the midpoint range at the Brent level. And then if you look at Asia, obviously, worst case, highest price we've seen for an oil because the Middle East crisis is right there central to that area. So you see this three bifurcation. And so you've got a lot of preparing for energy crisis. And what do we do? So you have liquidity raises. Then you have, so that's the first. The second part is a lot of the speculators that really jumped in. If you look at the January 29, that was the highest price ever for both gold and silver on that one singular day. That was a
Yep.
lot of speculators jumping into market. And now a lot of people took profits, like, oh my gosh, let me take some
14%
profits.
down.
Let me take some profits and move to yield because the dollar being so strong, again, for our energy ability to have, we have a
Yeah.
strong dollar that really has come up in the last several weeks. And so you'll see rotation out of non yielding gold and silver into yielding assets, especially with a strong dollar. So you've got a rotation to yield, you've got basically liquidity raise, profit taking. And then the third issue is because of the speculators and because it dropped so precipitously, you've got fear and you've got people selling now out of a fear kind of, I got to get out. This is now going down. And so you've got a three-part pressure on precious metals. The thing that we know from history is that anytime we see this kind of routing this quickly, especially when it's related to some kind of geopolitical event, we usually do see it doesn't necessarily happen immediately, but we do see a rally to a higher upside potential. So I would say for the long-term investors in metals, you'll still get a higher potential, but it could take a longer bit of time because people are going to wait for all of these things to play out before they feel comfortable taking going back into a non-yielding metals asset. But all of the fundamentals that are happening here, Paul, energy crisis, central banks liquidation, printing money, getting and inflationary pressure, having to accommodate, cut rates, not the
Yeah.
whole world, but cutting, accommodating, printing, all of that is inflationary and again would be served well with a metals position. So from a Bitcoin perspective, Bitcoin is interesting because it has not really followed any rules. Like it hasn't traded in tandem with the market. It now has not traded in tandem with precious metals. It's really its own asset class. And these are
Yeah.
the things that we need to see a cryptocurrency go through. So we have use cases of when an oil crisis or an energy crisis happened, this is what happened to Bitcoin. I think it is benefiting from the fact that it is so quickly transactional and it's just so fungible globally that it is something that you'll see rotation
Yeah.
into.
The rotation speed is and velocity is unheard of.
And I think
But
that
to
is
your point, yeah.
very much helping Bitcoin. And so it's good to see it coming back, but it did taper off quite a bit, just like metals did from its high, from its new high that we, after tailing off from the $100,000 range in January.
Okay, so with the Fed in their current position, you look at where gold and metals are playing, Bitcoin, of course, playing into this, the oil play, because this is really backwardation in reality. If you look at what's going all the way into December futures, you would think that the Fed would kind of avoid this transitory trap that they've seen before, right? Because you're talking about 6 to 12 months out, and if they're behind again and jobs continue to get worse,
Yeah.
and then all of a sudden energy just drops to the floor and we have no more inflation again, they would have been behind again on
Yes.
cutting rates
Yes.
and not saving American jobs.
That's right.
So
That's right.
with Warsh coming on, in I guess June would be his first meeting. Is that right?
Yeah.
Do you think he'll cut in June, or do you? I get obviously everything's on the table, but right now, what would you anticipate?
I mean, I think that would be a really, I mean, I know that's what Trump wants, right? But ultimately, I would look at him overall. I know he's been on both sides, but I would look at him overall as a hawkish person. Like, he is
Okay.
not a dovish, accommodative. At least I think his overall track record lends to hawkishness, which is a little bit strange because you know that Trump has called for
Yeah.
300%,
Yeah.
300 bit cuts
Yeah.
because, Trump is calling for 300 bit cuts because he's looking at funding the government
Yeah. He's
and
got to
not wanting,
refinance.
not doing everything on the short end of the curve like Yellen sort of instituted as, okay, if the long end of the curve, beyond 2 years is too expensive, we'll just fund everything on the short end and keep refinancing, refinancing, refinancing. So that's why he's requesting these huge rate cuts. People don't understand, why would he recall for a 3% cut? That's why, because
Yeah.
we've funded so much money since 2020 at a much higher level than we had prior to. But so I don't see how he could possibly, unless we get this oil and energy situation tied up with a pretty little bow by June, Paul, which is a tall ask based on
Yeah.
all of the actual damage that's occurred to infrastructure and to facilities that are going to take years to repair. If we don't get this all wrapped up in a pretty package with a bow on it by June, how is he going to have the ability to cut? Because I think we'll still be in some kind of inflationary pressure on
Real.
energy. And that's going
Yeah.
to make it very, very difficult for him. But to your point, you're right. We do have this potentially short-term energy situation in the beginning stages of weakness in the labor, which is a stagflationary situation, which
Right.
again would lead to, we need to be more accommodative. And so he's going to have a tall order to come in to get consensus, especially if Powell's still there, which it sounds like he will be until the DOJ
And he has a
inquiry
lot of
is wrapped up.
influence.
And he still has a lot of weight and
Yeah.
influence. And I think he
Yeah.
almost kind of wants to be a thorn in Trump's side. That's what he telegraphed to me at his last FOMC meeting comments. So to me, I don't think he's going to be trying to do Warsh any favors or in any way this Trump administration any favors. So it's going to be hard to get accommodation very quickly into June. And again, if you look at the predictions on the FOMC rate watch tool, we're looking at not until July of next year. That's what it shows right now. But it changed very fast, Paul. I mean, we were accommodative and we expected to be accommodative in April, and then it went to
Yeah.
June, and then it went to July, and then September, and now it's switched to, potentially hiking.
Yeah. Well, and I do think that we're in a very precarious situation because of just what's happening in Iran. Obviously, the energy impact is going to be deafening into the market if we don't see some relief on that. And because it has such a global, it's like a rolling blackout
Yes.
effect on a
Yes.
lot of these nations, including the EU.
Yes.
This starts to put a lot of pressure, I think, globally, because that changes the dynamic. Because if you have the European central banks and then you have the Bank of Japan, all of these banks are going to be responding in different ways because of their own situation versus what's happening here in the US. So the Fed's going to have to kind of lead with maybe the first separated movement, by a central bank in a very long time because it seems like everything has completely splintered apart just because of what's happening in Hormuz.
And I would just say, just add to that as a general topper of the overall assessment. This global world is literally priced for perfection. What I mean by that is we have to have accommodation. We have to have easy credit. We have to have
Yeah.
liquidity and easy money. And anytime that gets disrupted, you start to see immediate stock market routes, asset
Yeah.
value routes, gold, silver, real estate, private credit is a big instigator right now in this world. So liquidity redemptions on private credit being like Apollo public debt, obviously just they had an 11% request for liquidation. They limited it to 5. Blackstone last quarter had 8% distributions out of its B Cred fund, which
Yeah.
is its largest liquidation in a single quarter ever. You have Blue Owl, you have other private credits
Yeah. So
say we're
many.
not doing redemptions. And what people don't understand is the link in to credit lines with our largest banks with private credit funds. You've got private
Ye-
credit that's not publicly traded, non-public business development corporations that are relying on when they have redemptions going to their bank of, whatever credit line and drawing that down. So any kind of disruption just at a high level of liquidity system that has free flowing, easy credit, low interest rate capital is
Yeah.
going to be problematic because we are priced for continuous accommodation really since the global financial crisis, and we really in America moved to modern monetary theory, which let's just print infinitum
Yeah.
forever into perpetuity, and AI and all of the good things that come with that will save us and will make us fiscal cliffs that we'd otherwise be facing not
Yeah.
faced because there's going to be such an
No doubt. Well,
astronomical
I think
increase in
let me
productivity
let
that
me
we
ask you
will be able
something
to
here, Rebecca.
circumvent the fiscal
When
cliff that we
you
fall off.
because this is a thesis right now, especially around the private credit side. If you look at all of the SaaS companies, software as a service companies, I'm talking about private companies out there that are basically now getting literally eaten to the bone by the movement of what's happening in the AI market. So my thesis is that AI is eating the SaaS business. The
So
SaaS
true.
business has been feeding on private credit for a very long time.
So true.
Are we in maybe a critical point where SaaS simply starts really dwindling down? We could lose some major companies. That, of course, would have immediate impact on private credit. This also starts to get into the trickle in effect on all the companies that are in that software as a service that are publicly traded. So then the trade is out of that on a traditional security, and they're looking for another play, which is either digital assets. Maybe you go into certain other categories like energy or something completely non-related to what SaaS, the software business is. Do you think we could see a big play on that that's triggered by the private credit market?
There is no doubt. I mean, I looked at the scope of private credit just in the United States. It's estimated to be 1.3 to 1.8 trillion, and that is approximately similar to the 1.2 exposure we had of too big to fail mortgage-backed securities in the global
Yes.
financial crisis. So it's similarly in size situated, but it's obviously a different situation. What I think that it could be an instigator, it could be a financial contagion situation that could light a match
Whoa.
ball. But what
Whoa.
I am more concerned about is that it is not its own. Like when we look back at GFC, we look at too big to fail mortgage backed securities, credit default swaps, and all of those things that were
Yeah.
really at play. We have way more. First of all, our financial derivative sides is about 5x the what it was in global financial crisis. So that never really got tapped down. That has just expanded. But beyond the financial derivatives, you're looking at all of this happening. I call this the convergence of all things. We have all of this happening in the backdrop of an energy crisis globally, and the backdrop of going to stablecoins as the payment processing system of the world, moving away from
Mhm.
fiat, in the backdrop of the banks trying to finally come to some resolution with the Clarity Act, understanding that it's not going to be regulated by the SEC as a security, but it's going to be regulated as a commodity under CHSC, and basically saying, okay, you can't have yield on passively held, but you can give rewards for activity. So the banks are trying to keep stablecoins as not a banking situation yet, and they're going to have this little win with the Clarity Act, with this resolution that they came up with, but that is a temporary thing for them. And so there,
Okay.
we're looking at the convergence of the banking, of the international payment systems, of energy, of gold, of silver, of AI, all of these things at the same time, Paul. So if you look at S&P 500 chart and you clearly see .com, you clearly see GFC, we're going to look back at this time frame and we're going to see this is the beginning stages of the convergence of all of these things. And unfortunately, from an equity perspective of equities that are tied around software, equities that are tied around legacy things, it is going to get ugly. And you need to be able to get into the new rotation of the new things coming
Diversify.
if you are going to not participate in what's going to be, unfortunately, the routing down of the old guard, of the old school, the old ways as we move to the new ways. So this is really all happening at the same time. It's the convergence of these things together, and it is alarming and scary.
All right. So you touched on a few points there. We've been in Capitol Hill for the last several weeks. Our sources in there, and 2 weeks ago, we were getting indicators that there was going to be a compromise. The compromise most likely was going to be what you just mentioned, which was the loss of passive yields. It hasn't been completely done yet, but it looks as though what has been leaked out of DC at least is indicating that. I still am not sure if that's going to be the case. The concern that I have is when you look at the loss of passive yields, I wonder if something like a Coinbase who simply charges you for Coinbase One, that you have to do something to get Coinbase One, and then you get the yields that are attributed to or rewards, whatever you want to call them,
Yeah.
bonuses.
Yeah.
Would that be, I'm wondering if that would be just enough to be non-passive, to where you're just like, no, I actually have to do something to, I wonder if that's the gateways, because wouldn't this be somewhat subjective? Wouldn't you think it would be subjective as to what's passive and what's not passive?
This is where I love being a lawyer and I can talk specifically about how our political system works. So you get a law that's passed by Congress, the Clarity Act, which is actually pretty detailed, but or will be detailed as it is
Yeah.
written. But what normally happens is you just get a framework at the congressional level of the law, and
Yeah.
then the executive agency that is actually overseeing the implementation, the enforcement of that law will come in and write rules, regulations, and actual guidance and procedures. So this is why it's very important that the SEC does not regulate this as a security, but rather it is, not outside. It's outside of the purview of a security, and it's with the commodities board. And so we're going to see them write the rules on specifically what does it classify as passive versus. But this is what I'm telling you, Paul. This is a very, 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 very fine, thin line, and it will not stand. It will not last long. It is an interim
Okay.
step to get these banks on board to allow stablecoin to become the payment processing system of the world, and
Yeah.
certainly the United States. And as people, as adoption and as it becomes accepted, I will tell you that users will demand, I've got all my money in stablecoin and I want to return. And the banks are there. I mean, I have been saying we cannot put a legacy frame around new technology. And that's what this is, because the banks are trying to make sure they're still relevant. And
Yeah.
it is an interim step to give them a good feeling, but they will become irrelevant as stablecoins take over the currency transitions of the world. And this
Yeah.
is just appeasing them enough to let it go forward. But I can tell you, once it's massively being used as a banking relationship, and this is how I transact all my business, people will demand that I'm just sitting there, my coins are getting nothing. You will pay me something, and that will be demanded by the public in general. So good for that. It's a good compromise to get the banks to accept and acquiesce, but it will not stand. It will not stand. It's not even a possibility.
Yeah, well, I think the point you're getting at is this will be challenged very quickly in court of law. Most likely, passive versus non-passive will become super loose. Who knows what that
Like,
will be?
yep.
It could be the $5 a month Robinhood Gold, that
Right.
gets you, you know,
Right.
active use
Hmm.
of a Coinbase, or excuse me, of a stable coin.
Right.
All right, so let's talk, because I'm always concerned that these centralized exchanges, someone like a Coinbase, a Kraken, a Robinhood, that they could be exposed to capital flight if people fear. Because remember, it's the narrative that's coming out of DC right now that scares everybody. Oh, I can't get stablecoin yield anymore. I'm going to DeFi. I know what I can get over here with DeFi. I can stake something if I want to get into an asset. It's a completely different angle. Do you think we're going to see any capital flight into DeFi from some of these centralized exchanges?
Yes, and I think it will be very short term and temporary because, especially right now when you have a strong dollar, especially compared to the rest of the world with going
Yeah.
through more energy crisis than we will experience and disruption than we will experience as energy independent country that we are. So we do have a strong dollar. We have a strong dollar for a very valid reason. And so people will, on a short term basis,
Yeah.
get out of a non yielding asset. We've seen that with gold. There's been a massive flight just because people want to rotate into yielding assets while the dollar is strong, while interest rates can be thought to be going up, and people will get out of a passive asset that doesn't have any yield and move to yield. So yes, we absolutely will see that, but it will be short term. It will be short term because you have to get back in as we transition to stablecoin as the easiest transaction methodology to leverage instead of
Yeah.
using traditional banking methodology. You will see more and more adoption and normalization of stablecoin as our currency. And as that happens, whether or not the institutions demand, I'm saying the users will demand, saying we have to be able to have some yield. I've got all this money. I'm not going to take it from stablecoin, put it back into my bank. take USDC and convert it back to dollars, put it back into my bank, take it
It's
back
never
from my
going
bank.
back. That's
We're
for sure.
yeah,
Yeah.
so it will be, listen, this is an iterative process to get to new technology. It's iterative. So there's 2 steps forward, 3 steps back, 1 step forward, 2 steps back. And this is part of the iteration. And these banks and the banking lobby being one of the strongest, along with the pharmaceutical lobby and, the anyways, I'll just say that the banks have had a little win, but not a full win. They did not
Yeah.
get the ability to prevent yield on active transactions. And that was something they wanted as well, Paul. They didn't want any benefit for you using stablecoin, and they lost. They're going to lose that battle. And as it then becomes mainstay for everybody to be using stablecoin, the users will say, no, we're not using Bank of America or Wells Fargo or
Right.
JP Morgan like we used to. And now we want yield over here. It's only fair.
Okay, so this means that speed to market is going to become a big deal because now you have all these neobanks, centralized exchanges who are going after master accounts, companies that are becoming banks that were crypto companies 2 years ago. I mean, it's basically just a reformat of the finance system happening in
Absolutely.
real time, along with not only regulatory, but then now you have alignment between SEC and CFTC saying, yep, these are commodities. So you have all of this happening at the same freaking time. I mean, how long do you think it will be before we truly see a dent happening in the banking armor? How long?
I wouldn't put it any further out than 18 months.
Really, that fast?
Yes.
You feel that speedy? Ooh, I
Yeah,
feel like
because
we're there. You and I are there. We've been drinking the Kool-Aid for a long time. But listen, there's a lot of people that I talk to that are very wealthy individuals that are just now getting to the game. They just joined the club. So they don't even know where the tee box is yet. And they're in that position that do you think they'll just learn really fast like a lot of these, investment advisors like you? I know you guys know, but there's a lot of people out there that are like you that don't know.
Mhm.
Do you think that they will just get there much quicker, or do you think it's going to take this long education process?
I think that we are at the global stage of it is happening globally. And
Yeah.
that's why I was so adamant that we not allow the banking lobby to really bootstrap or handicap our
Yeah.
ability to develop this. Because if it doesn't happen here, there will be a market leader and it will be outside of the United States. So it is here. It is going to happen. It is not
Yeah, for
stoppable. It
sure.
is coming. And so what you have to look at is any new technology, you have to look at the adoption speed of any new technology that's really massive. Paul, you've got the early adopters, you've got the people that are out there, the cheerleaders. I'd say you're one of those. You're one of those that are an early adopter. But then you start to get into mass dissemination of new technology. And that's the
Yeah.
precipice that we're on. We're on the precipice, which is why the banks fought so hard on the Clarity Act.
They see it.
We are at the
Yeah.
mass dissemination of this new technology. We are at the mass rollout level, and that is going to happen over these next 18 months. And so I cannot imagine that we are not markedly on the other side of this 18 months from now. Because it
Wow.
is a
Okay.
very fast technology. And when you look at what's happening in the global world, especially under this Trump administration, it is going to happen fast.
Yeah.
I'm not suggesting that the banks are out of business in 18 months. I'm suggesting that the traditional way of everyone
They'll have
accepting how to trust
competition. They'll
it is
finally
something
have real competition.
real
Which
competition.
which I
Absolutely.
think is the biggest thing. I know a lot of people just want that alternative, which is why I think we've seen such a growth in Robinhood, Coinbase, all
Absolutely.
these centralized exchanges, and even in Circle, even though, Circle gets the news yesterday, things start kind of trickling out. And I don't know if you watched the Circle stock, but I mean, it was on
I
free
do.
fall. It was
I do.
30% down in a day. And I'm like, people, I don't know that this really hurts Circle in the long term. This is just a reaction, I think, in general. Where's Circle trading
I mean,
today,
Circle
man?
USDC, USD, US digital, coin. I feel like they have the second largest
Yeah.
circulation. Obviously, I feel like Circle is it actually has had some massive up days in the last 2 weeks, and so a little bit of down. Again, it's probably related to the fact that on March 20 we really got the banks to kind of acquiesce to say, okay, yeah, no problem.
Yeah.
We can accept no passive yield, but active yield. So that was, again, like a little bit of a ding on stablecoin, because clearly that's not exactly what, the issuers or stablecoin want. But again, I think it's an iterative process, and that's just an interim
Yeah.
solution. So that's why I think.
And even with the down day yesterday, Circle's up 30% in the last 30
Exactly.
days,
That's one of my
so
stock picks, and I'm sticking with it, and I think
yeah.
people would be long term very
That
happy
was a
with that.
good buy, by the way. I know we were
Exactly.
talking about that a while ago, that we
Uh-huh.
should get it somewhere around
Absolutely.
that 150 range.
Yep.
So nice pick there. Back on its way. If you look at the high on this, I mean, this stock was trading up at
Exactly.
what, $500 almost?
Yeah.
So
Whew.
this could be a big win for Circle in the coming months as people start to really understand this.
Yes.
And then I think we're going to just see a whole slew of creative products
Hmm.
coming to market that will solve the issue that the banks are trying to sidestep,
Hmm.
that may have sidestepped into a buzz saw, with what this might look like.
Right.
But anyway, Rebecca Walser, always fun having you on the show. Thank you so much for coming in today. Getting these global and macro understandings is very critical for a lot of you guys and ladies that are out there. So thanks for coming in. We appreciate it.
If I could just add, Paul, I will just want to just overall say to all investors, we are in a period of what we call capitalistic destruction, creative
Yep.
destruction. We are at the end of the old way, and
Hmm.
we are at the beginning of the new way, of the
New.
mass dissemination of the new way. This is going to be destructive. And so people need to understand that. They need to prepare themselves for that. Only put at risk what you can really afford to risk. And then there will be buying opportunities as the destruction comes and really impacts markets. I think that this global oil and energy crisis is a really good opportunity for us to see what could happen in the event of economic shutdown and shakedown, and investors just need to prepare. Volatility is coming, but the opportunities for the long term, the long play, you rotate out of this in the next 60 months and we're going to be a much different world. 60 months from now, this way that we're working is unrecognizable. So just encourage investors to play the long term game and not worry so much about the iterative destruction that could be happening in
Yeah.
48 months.
Well, just to kind of hit on that, this was dot bomb. I was a young engineer sitting in Microsoft at this era
Oh, wow.
where we pulled back in 2000. You guys know 2000
Hmm.
dot bomb.
Yep.
That was the S&P 500 right there, pulling back 50%,
Amen.
fully fully retraced. And then of course we know what happened after that. After that nice little run up, then we had this little thing called the financial crisis in
Yep.
2007 and 8. And then you had another major pullback right there. I mean, we'll go all the way down to the bottom right there, 56%.
Yep.
And I think these two events happened separately. These two events right now are happening at the same time.
Exactly. The convergence of all things.
Yeah,
Yes.
tech and finance, two sectors that
Together.
were, years apart, a decade apart almost from 2000 to 2010. And now we have this all occurring literally at the same time. So I don't mean that we're going to see those kind of pullbacks, but I mean, those are the kind of impacts that we're going to possibly see. So be ready.
Absolutely.
And it's either going to be the greatest time ever to be an investor, or if you weren't prepared right, it could be the worst time ever. So pay attention, people.
Yeah.
It is important. Rebecca, again, thanks for coming in today. We appreciate
Thank you
it.
so much for having me. I appreciate it. We'll be
All right,
with
see
you
you
again
later.
soon. Thank you.
You bet. Take care.